MedTech M&A. Who's buying who and why it matters.
Welcome everybody. So what we'll be discussing today is M&A activity, who's buying who, and why strategics are making such decisions. So this panel will focus on M&A activity in the medtech space, the trends that we're seeing, what's driving these strategic decisions, post-acquisition, how that's impacting innovation, acceleration, how startup companies can prepare, the different types of investors that are making these decisions. The panelists here today are well-rounded from all perspectives, so we've got bankers, strategics, innovators, multiple exit founders, family office, fund managers as well. So all sides of the table are represented, and hopefully we have wonderful learning experiences and advice. We won't have enough time today for questions. We'll all be in the back at the end for Q&A and connections, and hopefully be a healthy discussion today. So without further ado, my name's Ivanny Franklin. I'm managing partner of MedSight Capital. My family office began about 5 years ago when we made the exit of NAMSA, which is now privately backed by a PE firm called Archimed. In the past 6 years of NAMSA's history, we have made about 25 acquisitions and integrations, and I'm an active investor, primarily seed through Series A, B, C, through a variety of vehicles. So I'll let the panelists introduce themselves, and then we'll jump right into some strategic discussions.
Hirak Parikh. I'm with Johnson & Johnson on JGDC, which is the venture arm for J&J. We invest in both pharmaceuticals and medtech. I'm primarily focused on medtech. We've got a worldwide team that we try to cover the globe between the 12 of us. I'm based in Boston, primarily cover the East North America region, and this is my second time here. Welcome. I'm happy to be back here in Malta and looking forward to the panel.
Hi everyone, my name is Tom Busby. I am a partner at Mirus Capital Advisors, where I co-head our life science and healthcare investment banking practice. We assist middle market companies, predominantly with enterprise valuations between 20 million and just over $1 billion in merger and acquisition, build to buy, and capital raise initiatives, primarily from the private equity and growth capital communities. Been raising capital professionally for a little over 20 years, been dedicated to life science investment banking for the last decade. And this is my second time in Malta as well. Really happy to be here.
Hello, my name is Yves Prevoo. I'm a founder and former CEO of easee, and easee is a company that developed an online eye testing solution that allows people to do an eye test from home. And we had a software as a medical device, digital refraction technology, CE certified. We were on the run to get FDA approval, and then we were acquired a few months ago. And I think over the last 10 years, I learned all the hard lessons of building a startup and getting to the end, including fundraising and going through regulatory processes and scaling to 1 million ARR.
Hi, I'm Barak Singer. I'm with the Trendlines Group. We invest in the medtech field. We have today a portfolio of 25 companies. We also had 10 exits until today. Like most of my colleagues, this is my second time here in this conference in Malta, and I'm looking forward.
Great, thank you all. So I think a great place to start is the strategic drivers around acquisition. So from each of your perspectives, what is driving, whether it's innovation, portfolio expansion, diversification, what is driving the reasoning and parts of how you evaluate when to make an acquisition?
I can take that. From a J&J perspective, we are strategic investors, and unlike other CVCs, we are very, very closely tied with the operating companies. So we don't really make investments in pure white spaces or investments. It's nothing wrong with the company. If it's not strategically tied to some of our businesses, we won't make it. So I would call there some bread and butter investments, meaning these are things that our businesses need in the current moment. So that's a majority of our investments. But at the same time, we're also looking at what we call adjacencies to our businesses. So it could be not a white space, but something that is up and coming. Maybe it's a new modality, let's say like PFA in cardiac. That would be something that we want to disrupt ourselves and be disrupted. So that's probably one big area that we look at. We're always on the lookout for interesting things that could be businesses of the future. But we won't probably make an investment unless we have like an anchor investment. So a couple of years ago, we bought Abiomed and Shockwave. So now our cardiac business is growing. So now we are investing a lot in the cardiac space. So that's kind of how we look at it in terms of our investing strategy.
So if I could, from my view, I think the drivers for acquisition haven't changed in a long time, and there's really three. Either you have a company that is trying to enter a white space market where there is an unmet clinical need and you have a product that can totally attract that market. You have an asset that is going to allow a strategic to fortify a franchise that it has already built and expand that franchise. Or you have an opportunity to buy an asset to defend that franchise, sort of the fear or greed difference. I think, Ivanny, what is important, though, is that we shouldn't be able to block all strategics in the same sort of category. Every strategic has a different strategy. Every strategic operates their corporate development and business development functions differently. And every strategic has differences in what types of companies they want to engage with. And so that's where you have certain companies like Merit Medical. They enjoy going into white space opportunities. Cardinal Health would be another example. So you have very different strategies at play here, but the drivers, I think, have been unchanged.
Yeah, I think we were in the fortunate position that we had multiple offers along the 10-year journey. But I think it's really important as a founder to also think what kind of acquirer can actually help you achieve your mission. And I think it becomes pretty clear if there's not a business rationale from one of the acquirers, then what are they going to do with your technology? And it probably ends up on the shelf. And I think that's not something that I would be really looking for if you have built a company for 10 years. You want to see your technology thrive and be scaled to millions and millions of people.
Yeah, if you look at the M&A market, I think it's a mix. On one hand, you see this mega transaction, like you spoke about, Shockwave and Abiomed, which basically the large corporates are buying for their P&L in many cases. It improved the balance sheet. And there is consolidation after that. On the other end, there is the acquisition of innovation, which we are focusing on. In our case, if you look at our exit, in many cases it was pre-revenue or initial revenue. So for us, when Johnson & Johnson acquired two companies, it's good for Johnson & Johnson, it's good for the balance sheet. But for us, in a specific field, we have fewer companies that can acquire our companies. So we prefer to see it the other way around. For example, and I think we'll speak about it later, we see all the spin-offs these days, including also in Johnson & Johnson with the orthopedics. So when there is spin-off and we have new companies that are focused on specific field and large private equity financing them, for us, coming with the startup that we invested in, we have more opportunities for M&A, which is better for us, but it's always a mix.
So let's talk about that next then in terms of consolidation. So post-acquisition or merger, what's everybody's opinion on whether that accelerates innovation, yes or no? And how does it impact it?
So I think when we look at consolidation, it's usually a byproduct of some greater, more macro financial drivers. And not to bore everyone here with a financial discussion, but when we have high interest rates, you see companies starting to divest different business units, and that's what we have right now. Arguably, we have more strategics that could acquire businesses today than we did a few years ago because we had lower interest rates and we've had things moving around. With consolidation, I think one thing that doesn't get spoken about as much is the impact that private equity is having right now in medical device. So private equity has long time tried to be garnering the CDMO community. They enjoy that manufacturing business. More and more you see groups like RC Capital, 1315, Gemspring, as well as a rash of others that are trying to buy medical device businesses to consolidate. In terms of moving the innovation needle, overall, I think it's a good thing because they want to see products that not only have high innovation, but a strong business case.
Yeah, like I said before, for us, making a big anchor acquisition like an Abiomed or Shockwave just acts like a big boost. 5 years ago when I started J&J, we really didn't have a cardiac business. We've kind of been in and out of it. We didn't have a cardiac business, but now we have three big businesses that are very P&L. A big corporate needs something that's going to move the wheel and make money. But from an innovation perspective, that becomes like sort of jet fuel for us because now we have like a hunting license to go find all the innovative products to make those businesses better, right? So Abiomed, great pump, it's just an impeller pump, right? But the idea is that acquiring is we want to make it bigger and better than what it is. So we've been super active, as you all guys know, and people in this audience know that we've been looking at lots of structural heart. We're looking at lots of things in cardiac. And it's also acting as a boost for some of our other businesses like Biosense and Cerenovus as well, from that perspective. So like I said before, for us, specifically for J&J and the differences, which, Thomas can talk about, we are looking for adjacencies to our existing businesses where we have a right to win. Meaning there's some way, either we are scaling the product or there's some technology that we can give where it becomes multiplicative. Otherwise, we'll divest them, right? Like if they're not growing.
How about from a founder perspective?
Well, I think you quickly go into, especially in the medical field, let's put it this way, you quickly come into the problem of scaling, which is, you just cannot build a sales force to go and call on doctors or on hospital systems and those kind of things. But also, you're always stretched between being really focused on building one thing and being really good at that. But obviously, if you go to a big hospital system or an insurance company, you just don't cut it because they're not interested in one-point solution. They want to see, bigger solutions integrated into each other. So I think, I think it helps innovation a lot if consolidation takes place. But of course, it needs to happen at the right time and not too soon, I would say.
So that's a good maybe next question is the right time. From everyone's perspective, in terms of diligence and how startups can prepare themselves for M&A and deal readiness, anyone want to speak on from each table seat how you prepare or what you would suggest?
Yes, so as I said, we invest really in the beginning of the life cycle of a startup, really when the founders come to us. And one of the struggles that we have with some founders that we always tell them, you should start speaking with the strategic almost from the beginning. And usually there is a challenge between founders that are totally afraid from confidentiality and intelligence and things like that. And on the other hand, founders that after they make the connection with the strategic, maintain the relationship, but hassling them too much and sending email every week. So you need to build a relationship with the strategic from the beginning, not with one or two, with everyone, because sometimes you find the right potential partner and the right champion on the other side, but then J&J decide to spin off the orthopedics and you lost this candidate or someone moved. So you need to work with the strategic on a constant basis from the beginning, go to the investors conferences, to the industry conferences, and be prepared because you cannot have a sale process when you don't know the buyers years and years before the time. This is what you want to do. You want to be in contact with them until the moment one or two of them will come to you and say, okay, we want to upgrade the relationship. Maybe it will start with a strategic investment. Maybe it will go immediately to M&A, but you need to be in the position that everyone knows you. Everyone knows your plan. You speak with them. This is the regulatory plan. This is the reimbursement plan. This is the timetable. Sometimes things will happen. It will go slower in most cases, but they follow you. And you wait for the moment you get approached from one of those companies.
Not to be too provocative here, but you asked us to be. I would argue that diligence by a strategic makes having a colonoscopy without amnesia a whole lot easier. Diligence by a strategic, they will go through every single nook and cranny of your company. Preparing for that phase is very important, and that is where it doesn't need to be Mirus or myself, but surrounding yourself with advisors who do M&A day in and day out is going to help level an asymmetric playing field between buyer and seller. When you have a young startup company with 20, 25, 30 people being bought for hundreds of $millions by a strategic with thousands of people working there, you need assistance to be able to align what sort of requests are appropriate. So by way of example, one of the first requests that you get after an LOI is, give me all of your board minutes from the inception of the company. My response to that would be unnecessary at this point in time. Those are privileged communications, and if you want them, they're going to be redacted. Reason being that that strategic doesn't need that information at that time, and it also would be a request that would fall out of line in typical M&A processes. This is where surrounding yourselves by advisors is going to help streamline that diligence process and allow your company to keep performing. Oftentimes when you see a reprice in a deal, it's because the company has taken a nosedive in performance while going through that 6 months diligence phase, and now you get a reprice. By putting advisors around you, you're able to enhance the bandwidth that you need to get that deal done and keep things moving appropriately.
Do you feel that there's ever a time that's too soon, kind of to his point, and then Yves, I want to hear from your perspective, at what point, and speak very specifically, is it at the preclinical stage? Is that too soon? Is it at the clinical stage? Is it IDE? Is it, at what point in the process is too soon where you don't feel inundated, but you don't feel underprepared, or, speak very specifically about perhaps inflection points?
Yeah, so for us, from a MedTech perspective, you're not going to get acquired if you're not revenue positive. And that's kind of where we step in on the venture side, is sometimes it's too soon for the acquisition to take place, but it's not too soon to invest, right? So, Barak's aware we invested in OrthoSpin that we acquired later on. So we invested first. That's kind of our job on the ventures team, is to shepherd them through that process and maybe walk them through some of the stuff that Thomas was talking about. Is like, how do you get ready for acquisition? What are the things that you're going to ask? And he's not wrong, right? You're going to get a very, very thorough diligence. And in that diligence, if anything is uncovered, then the deal's off, right? So you want to surround yourself with really good advisors. And a couple of these on the stage, they've been through the process, right? So founders that have done this before, they are talking to strategics well before it's ready. And the point is that it may be not a bridge that you're going to cross in the present moment, but you have to be prepared to cross it in the future. And from an investor perspective, we love working with repeat founders because they know what's involved, right? It's not coming as a surprise why they're asking for stuff, or working with like really good advisors like Mirus that that can prepare the company for doing that. So our job on the investment is to prepare the company to get there. So the acquisition will take, and the acquisition could take multiple forms. We may do an option where we'll give you an upfront, and once you hit a certain milestone, usually it's FDA approval for a medical device, not before that, or it could be like once they cross like a certain milestone in terms of sales, and then we can put our sales force and get into like 20 countries or 100 salespeople.
Well, I think it's a difficult one, I would say, because you would spend a lot of. If J&J calls you, and you're like really early in building your company, of course you feel flattered and you are like enticed to do a lot of work for it. But I think it's exactly that moment that you have to think, maybe I should turn the tables and ask first questions on why they would be interested and what would interest them even more, right? And instead of spending a lot of time on due diligences. And I think I made the mistake myself as well, with multiple companies, and the larger the company, the more people involved, and the longer the process, and it takes a lot of resources and a lot of time, and it could have been more efficient by turning the tables earlier. And I think that's also making the relationship more adult, I would say, right? So you're more in the driver's seat, and you start building the relationship, and then at the point that you are actually getting to a value inflection point, such as FDA approval or clinical trial, that's the moment that you maybe, you know, willing to let them look under your hood.
I guess I'd just say, so Barak, I couldn't agree with you more that you should be talking to strategics early on. Very few people get into this industry because they want to hurt others. Most people are here because they want to help everyone. But you heard Hirak say we're only going to acquire a business that's producing revenue, so that's a little ways away. So I would say for entrepreneurs out there, be very careful about the conversations that you're having with investors and strategics. Yves and I were talking just a moment ago, be careful about putting a timeline out there that is 2-3 years out, and you have very little control over that. Because the next year when you go to follow up with that strategic and things have kind of fallen off the rails, they're now going to look at you with a more critical eye. So every time that you have that strategic interaction, be very thoughtful about the words and the facts and the plans that you're sharing. The other thing I'd say is, you don't have to go to bed with the first girl that asks you to dance. If you have a strategic that comes to you and shows interest, my thought is, let's go talk to every other party at that point in time. Investors, other strategics, tertiary strategics, because very likely someone else is going to feel similar. And that's incumbent upon you as the CEO to maximize optionality.
So what about advice on best practices for that engagement? So each of you are representing different entities and types of methodologies for investment. What advice would you have for startups on how to start that engagement? So you have each opinions on when to do so, but how about how, and how do you make the connections? How do you make the outreach if you don't already know somebody within the strategic?
Well, like in everything, if you have connection, if, for example, if you have one of your investors is familiar with the strategic, it's always better to start with an introduction, a warm-up. It's the same with investment. It's better than a cold call. So you start with that and you build it. And in some cases, if there is a new strategic or someone that you don't know, so you go to industry conferences and you build a relationship. But I'm all for building the relationship from the beginning. It's true, you need to know the other side. There are a few strategic that we are being more careful with them because, you know, we have people on our board, including people that work with, you know, in strategic companies. And some companies, not even, you know, speaking about, like you said, bad things, but some companies like to develop internally, and some companies are more open to take something external innovation. And you never know, to the comment that usually you will be acquired after revenues. Yes, this is the case, and these days you see more and more strategic sitting on the bench and waiting for more sales. But if we'll take our example of Orthospin, an external fixation orthopedic company, where JJDC invested, they followed the company, they invested. I'm always saying that this was the best first in human we ever had. They invested after the first patient. They waited, we did the first in human, one patient, and they make the investment, they laid the A round, they laid the B round, and then they acquired the company. So not every time it's the same, but in our case, it was a great practice, and also great practice to start with the strategic when they make a strategic investment without, you know, going for options and offers and things like that, which, you know, really narrow the opportunities, because we all know that in M&A you want to do competitive situation.
Yeah, I'll just say a couple of things. I think Thomas and these guys are completely right that you want to engage with other strategics. And speaking from a strategic perspective, we're not trying to steal your idea or steal your company. You know, we have other things to do than worry about those kinds of things. So the best thing would be do your research, you know, find out the strategics in that space. And the second thing is, you know, in your interactions, try to not keep anything confidential. There's a number of times I would tell, you know, decks that come in and say, please take all the confidential stuff out. Even if it says confidential, I cannot share it internally because we don't want to do that, right? We want to have a conversation. We want to know how you're doing. We don't want to know your secret sauce, because if we get interested, we will sign an NDA. There'll be a very thorough diligence when the time comes. That is probably not the time for it. It'd be just hey, you know, I met you last year. This is the progress that we're making, and, you know, keep us informed, because then at some point, you know, we will make an investment, you know, we will make an acquisition offer, whatever, right? So I think using those interactions in a smart way helps. You know, leveraging a connection helps. You know, your board is going to help with the stuff. Your advisors are going to help. Like your team is bigger than yours. And then, one company I was talking to, and he was a little bit shocked, he said that I interacted with more people on a diligence team than work in my company.
When you speak with a strategic or an investor, I can't impress upon everyone to really do your homework. Find out if that investor invests in your space. Find out if that company has had success in that space. Many entrepreneurs tend to overvalue their technologies and undervalue competition. It behooves of you to be very critical of yourself and really look at competitors, not only who are existing in the market, but other startups. Because when you go to Hirak and you show him a new opportunity, he's been mapping out that whole market for probably a few years, knows all the competitors and where they're at. When you do engage with a strategic, just ask them for feedback. Hey, Hirak, I'd love to get 10 minutes for you. Can I get a little bit of feedback? Explain the market that you're attacking, the unmet need that you're going after, and why you think you'll win in the marketplace. If they're interested in the backstory of the technology, they'll ask. But you want to focus more of that conversation on where you're going in the future, not everything you've done to get to that conversation.
Yeah, so I think, of course, networking, that's a basic role of a CEO. But I think one other thing that I now, in hindsight, learned is, especially in the beginning, you can get quite a good network through informal investors, right? So there's a lot of executives in big companies that are, also investing in all kinds of startups on the side. And I used to work in Pfizer, and I was doing the same thing. So I think that's also a great way to build a network and get some inside knowledge from these companies right from your own investor base.
This might be limited perhaps to Hirak, but how maybe from J&J's perspective or from a strategic perspective, do you decide whether to acquire externally or to build internally?
Yeah, so from our perspective, we understand that we have really good R&D teams, but we obviously don't own innovation. I mean, there's lots of great ideas across from lots of different people in the world, which is kind of why JGDC was created 50 years ago, with the intent that everything is not going to be invented here. And you're correct, right? There are businesses and there are certain leaders who feel like, no, this has to come internally. And I think that's very short-sighted. And we will make investments sometimes in two companies that are kind of working on the same thing. I mean, we're very, very careful in making sure there's no contamination. Because you never know. There's a lot of uncertainty. There's a lot of risk. Think the world changes rapidly sometimes. A new technology comes along and then, boom, like in 2 years, like, PFA has taken over in the last 3 years, right? Like 6 years ago is nowhere, right? Like there was cryo, like, so change comes very rapidly, very quickly. And like I said before, we are of the opinion that we want to disrupt ourselves, then get disrupted by another competitor, another company. I mean, it happened in robotics, right? Intuitive's been eating our lunch for a long time, and Medtronic and J&J, we've been catching up, right? So we've learned something from those lessons, and we don't want to repeat them too often, otherwise we won't be around for another 135 years. So I think our view is like, let's make these investments. We put small dollars to work. We work with a lot of people in this room with the intention that we're not the only people putting the checks in, and then the company still belongs to you. You are own master of your own destiny. And yes, if you get to a point, yes, we'll write the big check and acquire you, but that's kind of how we're looking at it, right? We're looking at trying to engage initially, make this investment, shepherd you through a process to 3 to 5 years. And yeah, if you hit those milestones and it's still on strategy and we still feel this is an area, we'll acquire you, right? As Barak well knows. So that's kind of how we look at it.
Do you notice a trend or a change in trends maybe over the last 5 years, or you mentioned over the last 50 of internalizing versus the external acquisition?
I mean, to be perfectly honest, a lot of the R&D stuff has been sort of like reduced in some extent. I mean, it's a lot cheaper for a startup to develop something than for a J&J. Like I think someone quoted it yesterday in yesterday's investor talk. It's like 10 times more expensive for a J&J to go through a process, which is we have a huge bureaucracy. People charge us more, right? They're going to charge a small startup less than they would. So the smarter thing is to invest or acquire that startup.
I'd only ask as a shareholder of J&J, I've been positively predisposed about the shift to inorganic growth. It can be a better use of dollars to spend on buying those technologies and leveraging your sales force than all of the R&D.
And how about maybe from your perspective, kind of post-acquisition, can you speak to your experience on integration and how, once that company, your company was acquired, how did that impact you and integrate within a greater portfolio? And were you well, maybe I shouldn't ask that openly if you were happy or not, but we'll keep that, not maybe too provocative, but I'll stop there at the beginning.
Yeah, so I cannot really allude to that because I didn't join the integration team. So I have my colleagues that are working very hard to integrate technology into the US ecosystem. So I think that's good, right? So the team has a good home. I think, there's always risk, I would say, if you acquire something, and there's a lot of tacit knowledge that even in the best possible integration will go out the window, and that's something, of course, you have to basically also factor in. So I think it's that also comes back to timing, right? So the further down you are down the path, the more solid the integration will probably be. In terms of what I'm a happy man. I'm ready for a new challenge, and I think also after driving a business for 10 years, it's exciting to think about new opportunities again and new businesses, and especially being here in the last day and a half already, I got so many new ideas that I'm quite excited for the future.
So maybe kind of while we're on that side of the table, how, and for your portcos, Barak, and yourself, Yves, how do you evaluate the right strategic partner if you have multiple buyers? How do you make those decisions or impact those for your portcos, or even in your perspective, your personal company?
Well, at the beginning, when it's before M&A, you do your homework about the potential acquirers. But when you are in an M&A process, and at the end of the game, you want the best deal for the investors and for the founders or for everyone. So when you are before an M&A, when, for example, if the company want to do structured acquisition or get some option or start with distribution or things like that, this is extremely complicated. Finding the right partner and what kind of terms you can leave it and what not. But if you are in an M&A process, at the end of the game, you want to have a few bidders, and whoever will give you the best offer will win, because at the end of the day, you give it to the other side. But I must say, in our case, if I look at Orthospin and EpiFix, a scoliosis company that we sold to Orthopediatrics, in both cases, the founder stays with the company, the team stay, they even grow the team a little bit. So we were quite happy also with not only the transaction itself, but also, at the end of the day, we want the devices that we are in healthcare. We want to see, devices that go to the patient and successful. So for us, it was mostly positive experience also post-acquisition.
So how about on a global scale? Many startup companies that we're all speaking with daily are trying to decide, okay, United States first, Europe first. From the investor perspective, how do you prioritize those? What are your suggestions for where startups should? You want to speak already?
I will start because it will be very simple.
Okay.
US first, and if we have any discussion, it's always why should we, like if we have a company that is selling and they are saying, okay, let's go to Latin America, or let's go to other places which are important. But for us, at the end of the day, the market is the US. Most of the acquirers are US, so the US is the market.
But say why. Explain why. Explain why.
Yeah, sorry?
Explain why.
Because this is the largest market. This is where most of the strategic are. You can tackle this market, like I spoke with someone from Europe, which I'm from Israel. Europe is easier for us, it's closer. But on the other end, you go to Netherlands, there are certain rules. You go to England, there are different rules. You need to tackle every country by country. So if you are a company with 100, 200 million revenues, you go globally. But when you are a startup, you start and focus on at least for me, on the US.
Yeah, I can second that. From personal experience, I think we were not the only company in our space. We definitely had the best product, the best clinical evidence, the best team, most revenue on the technology, but still we were not in the US, and I think ultimately our competitor that was in the US did much better in fundraising, did much better in strategic collaborations with strategic buyers, and I think if I would do it all again, I would probably start in the US because it's where the magic happens.
I'll let you two speak, and we're at time, but from a buyer perspective.
Yeah, from a buyer perspective, I think this is generally right. But from a J&J perspective, we also really watching China very carefully because there's a lot of technology that's coming from there, especially on the biotech front. On the medtech front, you tend to be a little bit 5 years behind. They are coming with not just copycat technologies, but better technologies. So we are really watching that. A lot of that is being built mostly for the China market, but also some of that is very low cost, which can go in Latin America, it can go other parts of Asia as well. But yes, I think generally as of now, it's true. You want to build, to get it for the US market. But, things are changing. From our perspective, from a corporate perspective, we are paying very close attention to some of those sort of, bigger changes because change, it comes very suddenly and then, very rapidly in a couple of years. So, we are watching from our perspective. We are a US company, so the market's important, but, we are also a global company, so it's important for us to be able to scale worldwide.
I guess I'll put a cherry on it really quickly. And being an American, it's easy to say, yes, come to America. But from a factual standpoint, our capital markets are more robust than any place in the world. Our legal frameworks are stronger than you'll find any place else in the world. We have a higher density of talent and education than you will find oftentimes. But it's capital markets, I think, really that drives the interest in the United States. We also spend more on healthcare than any other nation. And we are more interested in spending money on healthcare, even if it's out of our own pockets. In other nationalized systems, you have downward pricing pressures, which can, on an economic basis, kind of curtail the opportunity. So I'm biased here, but we're hearing that by and large come to the US.
Well, thank you all, and we're out of time, but appreciate everyone for joining, and we'll be in the back if anyone wants to speak further.
Thank you.